What if I told you there's a way to boost your trading accuracy by up to 95%? So in this video, I'm going to be revealing the secrets of order block and fair value gaps that will generate you thousands of dollars in trading. But before I continue, I would love to plead with you to hit the subscribe button and wait for my next content if you found this video to be very helpful. So the first thing that you do while conducting any analysis on your trading view is to determine the trend of the markets. So in this case, we have our trend of the market to be what? An uptrend. So after determining the trend of the market, the next thing that you do is to look for possible break of structures. In this case, we have our possible break of structure to be this. We have our possible break of structure to be this. We have a break of structure to be this. You get me? So after determining the break of structure, you check in the manner which price made that break of structure. Let's take for instance, this is what price does. Price makes a higher high, higher low, higher high, higher low, higher high, higher low. And each time it makes a higher high, it tends to come down to last opposite candle, which is our order block, and continue making higher high, making break of structures, which signifies the continuation of the trend in the market. So it makes what? A higher high, higher low, and it continues to go down. Now, where you should be paying attention is not just the order block. The exact place that you should be paying attention is how price breaks this your structure, how price makes your break of structure in the market. I don't know if you get me. So how price makes a break of structure, the manner in which price makes that break of structure matters a lot for you to determine which exact order block that you are going to be trading in the market. First of all, we are supposed to be expecting a bullish impulse, an impulse here. We are supposed to be expecting a bullish impulse here, a bullish impulse here, a bullish impulse here. I don't know if you get me. A bullish impulse that will lead to a break of structure. In this case, the same thing in this case, the same thing in this case. What we are looking out for here is to see if the manner in which price made this break of structure is aggressive or non-aggressive. You understand? So whether it is aggressive or non-aggressive matters a lot. When it is non-aggressive, you are not expected to trade the order block, because in this case, we should be seeing something that looks like a choppy candlesticks and not really what? A big impulsive candlestick like this. We should see at least 2 or 3 big impulsive candlesticks like this that will lead to a break of structure. Not choppy candlesticks that looks this way, has many wicks. Choppy candlesticks, because these choppy candlesticks, on the other hand, are called liquidity, because they have a lot of liquidity inside them, thereby they cannot be considered as an aggressive break of structure because of what? Liquidity. And liquidity in the market means trap set by the big buyers or the big banks to take out the retail traders in the market. You get me? So after determining the manner that led to this break of structure in the market, we should be looking out for order block that tends to be at the extreme zone. At the extreme zone, something like this. You understand? So we should tend to look out for order blocks that are the extreme zone, because these order blocks are the only order blocks that tend to work. Another thing to look out for while trying to spot a valid order block should be this. The more time that price returns to the order block, the weaker it becomes as a support or resistance level. The common mistake that people make while choosing their order block is that they tend to choose any candlestick. Meanwhile, while trading order blocks, you tend to choose a specific kind of candlestick I'm about to show you in this video right now. So at your support and resistance level, you tend to see candlestick that has big wicks. Some have wick like this. You tend to see some choppy candlesticks that has big wick. It could be up or it could be down. But the only candlestick that you should be paying attention is a full body candlestick, just like this and this. You get me? So look out for only candlesticks that have what? A full body. A full body. It doesn't have a long wick up and it doesn't have a long wick down. If you don't see this at your extreme zones, leave the trade and move on to the next one. That's way you cut your losses. Fair value gaps occur when there are more buy or sell orders at a specific price level creating an imbalance. And by that, I mean this. So whenever you are trading and in between 3 candlesticks, you tend to see a gap that looks like an imbalance. It is a fair value gap. So in my next video, I'm going to be talking about the difference between an imbalance and a fair value gap. So if you are new to the channel, you subscribe and wait for the next video. The first thing that you determine in your market, the first thing first is what your trend of the market. It matters a lot. So before doing any analysis on your chart, you first of all determine the trend of the market. So after determining the trend of the market, the next thing you look out for is the possible break of structures, which I've always said in every of my video. You must look out for what possible break of structures. In this case, we have our break of structure to be this, this, and this. You grab. Then price tends to move in this manner. In terms of an uptrend, price tends to move in this manner: higher high, higher low, higher high, higher low, higher high, higher low, higher high. So in this case, we are not expecting price to come back to the extreme zone. We are no longer using order blocks as our entry now. We are using fair value gaps as our entry, no longer order blocks. You get me? So because when it comes to the use of order blocks, we tend to look for our order block at the extreme zone, at the support and resistance levels, at the extreme zones. But when we are using fair value gaps as our entry, we tend to look for our fair value gap in between, such as this. You must have heard a popular saying in the market that price moves from liquidity to liquidity, and fair value gap serves as liquidity in the market. The big banks are the ones, the big institutions are the ones that set these traps called fair value gaps, with respect that they are going to come back and sweep or take the money which they have kept somewhere in the market and continue moving in their own desired direction. So you have to be wise enough to spot a fair value gap in trading or in your analysis. So at the end of this video, you should be able to know which strategy suits you best, whether you are going to be trading fair value gaps or you are going to be trading order blocks. First thing first, I determine the trend of the market. My trend of the market is bullish. So after determining the trend of the market, I move over to the chart to look for my possible fair value gaps, the place which I would possibly spot liquidity in the market. And in this case, I've already seen one. First of all, as I have said, you spot your what? You look for what? You look for the trend of the market. After determining the trend of the market, you look for your possible break of structures. In this case, we have this as our break of structure. So after price made a break of structure, you could see from this that price made a break of structure using a very big impulsive candlestick. This is what I've been talking about. You can see the manner in which price made this break of structure. Price made a break of structure here using a very big impulsive candlesticks. Thereby, this impulsive candlestick tends to create our fair value gap in return, which is this, our fair value gap. After price has done whatever it wants to do at the top, it will come back here, which is our fair value gap. Tap into it and continue moving upwards. First of all, determine the trend of the market, and in this case, we have a downtrend. So after determining the trend of the market to be down, we look for possible break of structures. And in this case, our possible break of structure should be here. This is a break of structure here. So we made our break of structure to be here. So after the break of structure, the second thing you should look out for is the manner in which price made this break of structure. Here you can see the manner in which price made this break of structure, and the candlestick is very bearish. It is a strong impulsive candlestick which created a gap. It created a gap for us after making this kind of impulsive move. So this break of structure here has now led price to leave a fair value gap for us for entry at this spot. You can see that. So this here is our fair value gap. So in this case, we are talking about when the price is moving down for a downtrend. First of all, you determine the trend of the market. Secondly, you check the manner in which price made the break of structure. And in this case, the manner in which price made the break of structure is clearly this, a very impulsive bearish candlestick, which signifies that price would always come back to fill it up at this level before continuing to go down. So in this case, if we are to trade this, our entry should be somewhere around here, while our stop loss should just be above the fair value gap. and then you can target as much as 1:5 risk to reward, and that is just it. So first of all, I determine my trend of the market, which is uptrend. So after determining the trend of the market, I look forward to what possible break of structures in the market, and in this case we have our possible break of structure to be this here. And after the break of structure, you can see how price returned back to the order block, and you can see how strong this order block looks. So price deliberately returned to our order block. So if we were to trade this normally, we are going to place our entry at the 50% of this order block, and then our stop loss at the end of the liquidity zone of the order block. Then you can target as much as 1:3 to 1:5 risk to reward, and we are good to go. So this is how easy it is to trade order blocks and fair value gaps in the market. First thing first, you look out for the trend of the market. So after looking out for the trend of the market, it could be uptrend, it could be a downtrend. You look out for your break of structures, after which you look out for whether it is an order block or a fair value gap that you'll be using for your entry. So in your opinion, which strategy do you think works best, and which do you think you can trade from this video that I have made?